When trying to optimize investment decisions, first we have to realize that we're human. And because we're human, we have inherent biases. So what do these biases do? There's been a lot of research in this field by Daniel Kahneman, who actually won the Nobel Prize. And Kahneman found that people actually have two different areas of their brain. The first is the reptilian brain, and if you think about that, if you're driving down a road that you've been down many, many times, you tend to drift off. You're driving in the right direction, but there's no thought. Then if I asked you to do a complicated math equation, there's actually biological things that happen. Your pulse quickens, your blood pressure goes up. You can literally feel your mind move from one autopilot area to an area that's engaging in cognitive reasoning. The advantage of the reptilian brain is that it allows us to sort mountains of data. The problem, however, is there's many decisions we need to make that you shouldn't make quickly. And so what you need to do is override your reptilian brain when you're making important decisions. At Origin, we've spent over a decade trying to optimize decision making in investments. However, we realized 3 years ago that we're lacking one fundamental thing in this equation. We don't have an objective risk model that completely eliminates human bias from the equation. Now, this isn't to say that it's going to override every other part of our decision tree, but we wanted to see if we could develop something that was based on all of the data we've collected over the last 10 years and current deals, and see if we removed all biases, what would that result be? The way the risk model works is it's looking to try to find the correct return for the risk taken. And so some of the risks that we see in real estate deals include asset level risk. Very simply put, multifamily, which is what we invest in predominantly, is one of the lowest asset level risks you can take because it's a good that you have to consume. You need a place to live. In contrast, if you were talking about hotels, that's an asset class that you absolutely do not need to consume. You don't have to take a business trip. You don't have to go on a vacation. Further, a multifamily lease tends to be 12 months, while a hotel lease tends to be one night. And so you have a much longer contractual income stream with multifamily. So for those two reasons, that's an example where the asset level risk required on a multifamily deal should be lower than a hotel deal. The second thing we look at is debt to equity risk. The more debt that you're going to use on a deal, the more it puts your equity at risk, and it needs to be reflected in the overall return to equity. The other factors that we look at consistently are which cities and submarkets are we investing in, what's the vintage of the asset, how old is it, the useful life, the quality, as well as structural risks of the deals. Very simply put, the more competing interests in a deal, the more complicated the deal, and the more you need to be compensated for that complicated structure. At Origin, we tend to like to do deals that are very simply structured. We believe that's a less risky way to do business. It took us years to build and test the objective risk model, and what we found was the objective risk model is amazingly predictive in investment results. We tested it on the 40 deals that we had actually invested in, but moreover, we tested it on the 50 deals that we had decided not to invest in that had made it all the way to credit committee. The model not only predicted should we do the deal or not, but it was accurate in predicting which deals would perform the strongest and the weakest in the portfolio. There are two lessons that we learned specifically from backtesting all of this data. The first is that off-market deals aren't necessarily higher expected value than on-market deals. At Origin, we do about 50-50. We do half of our deals on-market and off-market. And there really is no rhyme or reason to what will have a higher expected value and a better investment performance. I think going into the objective risk analysis exercise, we would have thought that off-market would have overperformed. The second lesson that we learned is that getting into joint ventures doesn't necessarily increase your investment return. Many of our off-market deals are through joint ventures where we're doing what we call recapitalizations. And while those deals have been successful, deals that we've purchased directly and executed the business plans directly in a more simple structure have performed equally well. So what we know now is that both are effective strategies. The most exciting thing is the model will continue to improve as we put more and more data into it. So with every week and every month and every year, it just gets smarter and smarter. Now, that being said, optimal decision making remains a marriage between the subjective analysis this unbiased view, this way to get us out of the reptilian brain and into the data brain, but also into the subjective world of judgment and accumulated knowledge, and that can't be discounted either.